Coming up today, stock market complacency nears highs. I'll show you how I'm hedging a fall. Atlanta Fed forecasts GDP growth of 4.2%. The 1% still want their rate cuts. Signs of froth in the market, the latest earnings reports, and the market continues to ignore the warnings coming out of the Kremlin. Hey, what's up guys? Welcome back to the Daily Market Review. On a rather benign day in the markets, S&P 500 pretty much finished flat, 51.87, exactly where we finished yesterday. And like I was saying, I thought we may stall out around this area just below 52, possibly just above it, where there has been a little bit of prior resistance this same time last month. And we're currently in an environment where stock market complacency is nearing record highs. We can see that in the options market, not just the really low level of the VIX, but also in the skew of out-of-money puts relative to at-the-money puts. Dropping down to lows as well, meaning not many people are buying insurance here. And we can see that again today in the options market. 55% of all volume traded was calls. And that is showing up with a really low VIX index, which is derived from the implied volatility of S&P 500 index options. And so it's the market's expectation of what the next 30 days of volatility is going to be, expressed as an annualized percentage. So right now the options market is expecting stocks to track around 13% annualized volatility. And so don't get me wrong, we are in a bull market. The market is tracking well, it's uptrending, and most of us have long portfolios. So where can we add some diversification or potential hedges if we're worried about a correction or some sort of surprise? Maybe Russia goes through with its threats on using tactical nuclear weapons. Something could come out of the blue that grabs us all by surprise. Well, traditionally, having an allocation to bonds had always been good for diversification. They're normally negatively correlated to stocks. However, we're still in the midst of the worst bond bear market in its 250-year history, and even got probably the man who's traded more of them than anybody else and became a billionaire from trading bonds. Bill Gross said bond funds are dead. And that's because of record US government deficit spending, which should keep upside pressure on yields for years to come. So some other ways you can hedge, probably the most simplest, is just to buy a put option on the S&P 500, or you could short some high growth stocks with a stop, of course. However, one of my favorite ways to hedge the market, especially when complacency is high and volatility is low, is to put on a VIX bullish call spread using VIX index options. Those unfamiliar with index options, they're European style, meaning they can only be exercised at expiration. And contrary to popular belief, the VIX options are a derivative of VIX index futures, not the VIX cash index itself that we look at every day. And typically the VIX futures trade at a premium to the VIX cash index. So just looking at the VIX futures contracts, for example here, by default it'll always show you the front month. However, just looking at the November contract with settlement day on November 20, it's a couple of weeks after the US presidential election, you can see it's currently trading at 17.52 versus the cash index just below 13 there. So there's 4.5 points of premium in there. And basically, as each VIX futures contract approaches expiry, it'll converge with the cash index and evaporate that premium. That's why long volatility ETF funds have so much decay, because they're constantly rolling over and giving up that premium. So this is one way you could hedge the market going into the US presidential election. Buy the VIX November contract. I'd say there's a very good chance it trades above 17.5 at least some point before the election. However, the hedge I put on today was in the July contract options, and here's how it's built. So I went long the 12 call strike, at the same time short the 19 strike. That's what's known as a bullish call spread. And so right now the midpoint is around $2.40. Each contract worth $100. So to put on one contract, that'd be a debit cost of $240. That's the most you can lose on the hedge. And with bull call spreads, the maximum loss is realized if the underlying is below the long strike at expiry. The maximum profit is if the underlying is at or above the short strike at expiry, with the max profit equaling the distance between the two strikes, which is $700, minus the cost of the spread, $240. Just opening up a profile, there's a look at the risk reward. So max return is shown at $437. However, that's based on the ask and bid prices. The good thing with interactive brokers is you can trade the spread as one price. So you can come up here and enter in a limit, which I normally do halfway through the spread and just wait for it to get filled. So filled at $240, the max return's actually $460 and the max loss is $240. And the break even's 14.59. And so even though the July contract's at 15.35, looking at the front month fixed futures, that's 13.97. So that break even of 14.59, half a point higher. So in other words, we got 68 days till expiry on the July contract. And by the time we get to July, or even in June or thereabouts, the front month VIX is trading above 14.5. That spread will be in the money. And like I said, max loss is below 12. However, I make my decisions just based on the cash index. So I have a resting sell order for this spread once the underlying cash VIX hits 19 or above. You can also set that up in Interactive Brokers. Resting sell order based on the condition of any asset hitting any sort of price. So if it pops up there when I'm not looking at the screen, it'll automatically sell for me. And that's where the max profit is, even though that's not realized until closer to expiration, because there'll still be some time value on the short strike before then. And the good thing about this spread is it's theta positive. Unlike most long option strategies, you have to pay theta, that time decay. This one's a little bit positive, and that's because of the steep skew and implied volatility. So when I buy options, I always buy them in the money, regardless of what sort of trade. So here I was paying about 48% implied volatility on the long strike, and I was selling the short strike at 81%. And because there's such a steep skew in VIX options, you can actually put on a bullish call spread with positive theta. And the good thing about doing a bullish call spread is your long short options, it kind of neutralizes the Greeks and allows you a way to kind of play the VIX index without paying so much decay. Of course, what you give up in return is any gains above 19. For example, here, my 12.19 spread. And so that's a way for me to hedge. And most of the time I can turn these spreads into a profit. And typically the best time to exit a long VIX hedge is when the VIX futures curve goes into backwardation, normally in contango, and that means the further out we go, the higher the price of each contract. However, when fear spikes, so you're looking at a spread chart here of the front month versus the second month, that'll go above break even. We can see that was on the 19th of April, and just going back to the VIX index, you can see that was on that big day there. So that was an easy signal to get out of any long VIX, and some people can even short volatility at that point as well. However, I'm not one for actually shorting volatility, because when you're long stocks, you're pretty much short volatility. And like I said, this is a hedge for my long only portfolios. And so the plan is, if the VIX were to keep crushing, then I'm going to sin a little and martingale into this. And so if we come down to low 12s, which we very well could, I may add an 11.18 call spread. And because I know we're coming up less than 6 months to the presidential election, we're going to get a spike at some point, some sort of surprise. And so I'm happy to leg into my VIX hedge bullish call spreads here, especially when we've got the VVIX. That's volatility of volatility, the implied volatility of VIX options down near decade lows. So VIX options haven't been this cheap for quite some time. And we can see that with the IV on the 12 strike that I bought. 48%, which is just about as low as you'll see it. And so I thought that was just something interesting I wanted to share with you guys. Another way to hedge the market most people don't know about. And so if you enjoyed that and found some value and would like me to keep sharing things like this, then show some love and hit that like or love button, whether you're on YouTube or X. And that lets me know you appreciate these videos and helps my channel out a great lot as well. And if there's any other particular subjects you'd like me to talk about or cover, then just drop a comment. I'm always interested to hear from you guys, and I read every single comment below my videos. So let me know if there's any other particular subject you'd like me to dive in my daily market reviews. Okay, just moving on with today's review. Like I said, even though I've got a VIX hedge on there for any potential surprises and something I plan on adding to, especially the lower we go into VIX, as I do expect we will get eventually a big VIX pop sometime before early November in the election. And with my trade setup, gives a really low downside, limited risk, and a chance to make more profit than that risk. Don't get me wrong, this is a bull market. We have got a lot of seasonal patterns that suggest we will finish the year higher. Even though we could get a correction or pullback before then, the odds are, like previous election years, under a new president, they've all finished higher, on average 12%. That's why I'm not outright short, net short, calling for a bear market or anything like that. I'm just hedging my long portfolio's profits and what I think is a good risk-reward trade. And just stepping back further again, this bull market is still quite young. On average, bull markets last about 60 months. It's about 5 years. And if you count this bull market starting from that low in October 2022, then we're only about 19 months in. And looking at bull markets that start in October, they actually performed a lot better. Looking at the average changes, for even the one in 1990 went on for almost 10 years, sending the S&P up 4x. But something that's got me a little suspicious here is, yes, we've got all these great seasonals. However, the market's punishing stocks that are missing on earnings a lot more than normal. In fact, the worst it's been in about a decade. Stocks that are missing EPS expectations down 4% the next day. Stocks that are beating only getting mildly rewarded as well. However, when the Fed is on pause, which they pretty much have been since their last hike in July last year, it's typically a time when the market does well. Just looking at the blue bars here, the number of days between the last Fed rate hike and the first rate cut, then in the orange, the S&P 500's return during that pause. What you'll notice is a pattern is the longer the pause, the greater the return. And so it's not typically until the Fed cuts and the stock market rolls over, and it's typically cutting either because unemployment's spiking or there's some other external shock or surprise to the system. Not only that, we just got the latest forecasts from the Atlanta Fed, and which not many people are talking about. However, they now estimate real GDP growth, seasonally adjusted in the second quarter for this year, at 4.2%, well up from the 3.3% they were forecasting about a week ago. So in their eyes, the economy's on fire. 4.2%. That's a well above average trend. And so it should be no surprise, especially in election year. We've got the stock market less than 100 points from all-time highs. However, the 1% still want their rate cut. Things are not good, they say. Like Barry Sternlicht, huge real estate investor and a massive beneficiary of rock bottom low rates over the last decade and a half. He wants to put public pressure on the Fed to lower rates, even going as far as to say this is not your grandmother's economy. He wants to widen his margin between the cost of capital and what he can rent it out for. So of course, he is talking up his own book. And whenever we have a rip in economy and market, that inevitably attracts froth into the market. And we can see that already with the launch of leveraged single stock ETFs and the assets they manage doubling this year, now over 7 billion, well up from just a couple of years ago. Less than $1 billion. And these are ETFs, like the 2 times leveraged long NVDA under ticker NVDL. You can just see on the weekly chart here that huge increase in trading volumes since the start of last year. And so that's typically a sign of a frothy market. And so you never know. There's a first time for everything. Maybe these seasonals don't play out. And wouldn't it be an upset to the prevailing narrative if this market did roll over? And in another sign of froth, it was NFTs. Pictures of rocks and monkeys a couple of years ago. Now people are collecting gathering cards. You're looking at the Black Lotus Magic, just sold for a record $3 million. And that was after rapper Post Malone paid $2 million last year for another one of these gathering cards. And just looking back in history, these rappers don't have the best track record when it comes to buying these unique collectibles. And just like we saw with the food and drink pricing at the Formula One Grand Prix in Miami, another sign liquidity is flush out there. $40 steak and lobster sandwich at the New York Mets game. And there's a photo of it there. I'm not sure about you, but would you pay $40 for that? And this froth liquidity, ripping assets, the Fed wanting to cut rates, comes at a time when most Americans, especially young millennials, saying food costs are the biggest strain on their finances. And that's because a lot of people feel as though their price of food is going up much more than the 3% inflation headlines that we see out there. However, all that doesn't matter to Wall Street. Goldman Sachs saying NVIDIA could surge another 22%, and it's still cheap compared to its peers. And they could be right, because expectations for capital expending on cloud by Microsoft, Alphabet, Amazon, and Meta combined is expected to accelerate the rest of this year and going into next year. Expected to reach almost $200 billion in CapEx AI spending next calendar year. And just looking at my stock fair value indicator for NVIDIA, just got it as 15% overvalued. However, I would say it well and truly deserves at least that premium, maybe even more. So I'd say around $900 a share. It is pretty fairly valued, given its growth rates, high margin, and then the fact it's still head and shoulders above the industry when it comes to their GPU chips. And so I still expect NVIDIA to become the largest company in the world and most likely overtake Microsoft this year, which is still a little bigger at a little over 3 trillion market cap versus NVIDIA's just below 2.3 trillion. However, my fair value's got around 250. I'd say it does deserve a premium, so probably closer to 300, I would say, is fair value on Microsoft. But it's such a loved stock in so many people's portfolios, it's probably going to trade at a premium for a lot longer unless we have a real crash in the market or cloud, maybe next year or going into 26. However, people forget America's not the best performing stock market this year. It's actually China, and it's still really hated. Probably the most underallocated asset category relative to its size in the world. We can see that with short interest in the iShares China Large Cap ETF, still near record highs. Most people have just given up on China. However, the price action begs to differ. After we get those big momentum thrusts off the lows earlier in the year, this uptrend has just held on, only done a few little dips there, and we just got another big momentum up thrust last week. And even though the market started off the year weak, we're still up over 15% year to date. And just going out to the long-term weekly chart, this has the potential to stage the mother of all recoveries, and that huge divergence between global stock markets could actually converge this year, just as the CCP wants it to. And we're about 3/4 away through Q1 earnings season. Got a look at ride-sharing stocks today, Uber and Lyft. Uber missed, reporting a loss of 32 cents a share versus expectations of 22 cents profit. And Lyft surprisingly came out pretty good revenue growth, up 28% from a year earlier. Also beating on the bottom line as well, 14 cents reported versus 7 cents estimate. And there's Uber with that surprising loss. The market punished them down 5%. Also just heard from Shopify. And even though revenue rose 23% from a year ago, ahead of expectations, stock still got pummeled, even though forward guidance just came in a touch lower than expected. Like I showed you earlier in the review, this market has no tolerance for anything close to a miss, and so the numbers look good on the surface. However, the market still sold them off 18.5%. We also got a look at Robinhood, seeing a surge in net new deposits. First quarter earnings are 18 cents a share, record revenue 618 million, beating estimates, and actually showing some good profitability compared to the loss of 57 cents per share first quarter last year. This is on the back as they expand outside of commission-free trading into retirement accounts and credit cards, and that helped them increase their assets under custody 65% to 129 billion. It's quite sizable now. And just going down to 5-minute chart after hours, We initially got a pretty good pop there, up over 6%. Now it's just pulled back a little bit. Currently up about 3.5% after hours. Let's move on to commodities. Market did a bit of a buy the dip on crude oil. Even though oil and gas inventories came in a bit higher than expected, it was still a decline in the amount of supply out there. Maybe the market's still on edge a little bit with what's going on in the Middle East and Ukraine. Getting some pretty big warnings out of Russia, which in a normal market, maybe back pre-2020, before the governments nationalized the stock market, this would get things really worrying and upset. However, not so much here. Market doesn't seem to care at all. As the West looks to include Ukraine and NATO, potentially deployed NATO troops on the Russian border, and a clear escalation and aggravation towards Putin, to which he won't want to be seen as weak and will have to respond, currently threatening tactical nuclear weapons, for which he's currently testing and running nuclear exercises. However, like I said, the market's pricing in no tail risk. This market's priced for perfection and that nothing's going to happen or go wrong this year, as we can see in the really subdued VIX index. And so the GDP forecast from the Atlanta Fed just been revised massively upwards, 4.2%. Stocks and cryptos just below all-time highs. Unemployment still below 4%. Inflation ticking back up. And what's the Fed forecast to do? It's going to cut in September and December. And that, along with seasonal patterns, should be very supportive of the stock market this year. Going into that, and barring any surprise, and still the real possibility, unemployment could still spike, in which these cuts may actually be justified. But for the here and now, things are looking pretty good. Bond yields seem to have found their footing, got the 2-year just above 480. Same with the 10-year, holding at 450. Bitcoin still moping around, as is gold coiling up, and there's a look at crude. Putting in a bit of a hammer candle formation. We dipped down there, the market bought that dip, closed right back up at the highs, just below $80 a barrel. And there's a look at wheat and corn, seem to hold on to their uptrends. And the copper gold spread, holding on to its breakout as well. And just looking across stock sectors, mostly down, bit bearish and mixed. However, the standout was utilities. Out of all the major sectors, finishing the highest, up 1%. Like I said, walk on the line, parabolic momentum. Bond yields coming off's helping that, and maybe a bit of a stagflation trade as well. With dividend stocks the best performing factor today. Cannabis may be finding its footing here, around 880. So this is not a bad dip buy zone, considering we're trading lower than before the news came out. The DEA's on the verge of rescheduling. There's Tesla, fallen again today. As we just got news, US prosecutors are examining whether Tesla committed securities or wire fraud by misleading investors and consumers about its EV self-driving capabilities. So once again, just more mess and headwinds, and I think the stock's going to consolidate at best for a little while. There's Meta just a few points away from kissing the 50-day VWAP, and a follow-up on yesterday's commentary on A-Mark Precious Metals. Earnings came in a lot lower than expected, however revenue beat and is still growing. 13% year over year. They added more customers. They just had compressed margins, some acquisition costs, and a few other internal logistics as to why they completely missed on EPS. However, the good thing is, market appears to have bought the dip right off the open on big volume. So technically, that's a good sign, even though we may retrace and come back down here and test. Just like this candle back here, that shows big buying. And so I still like this stock for the long term. Still got good valuation, good management, a dominant leading business in the industry, and the tailwind of the commodity boom. In addition to utilities, we're getting some other defensive names starting to break out. There's Coca-Cola, Pepsi as well, drifting a bit higher, Walmart holding on, and Procter & Gamble also hitting multi-month highs. And there's a look at the big banks. Wells Fargo having a good day, Bank of America, Citigroup, and JP Morgan putting in a solid 2% day. Alright guys, there we have it for this rather quiet midweek trading day. Like I said, we don't really have much out on the economic calendar this week, just making our way through to the back end of Q1 earnings. And even though earnings are coming in largely better than expected, on average year-over-year growth, 4.5%. Market's got no tolerance for any misses. That, combined with a bit of a defensive rotation, the only really two bearish things. Other than that, we've got yields coming off, oil's come off, along with a pullback in the dollar and inflation expectations. Most sectors are above the short, medium-term trends, and we're still only 100 points away from all-time highs. However, that's all showing up in the VIX, like I showed you. Complacency all-time high, and the best time to hedge is when it's cheap, not when you have to. You don't wait till your house is on fire until you buy fire insurance. And like I said, I'm happy to dig my heels in on this trade and add to it, because I know we're going to get a pop in volatility at some point before November, and I'm going to be there to cash in on it. Thanks very much for tuning in with me today. Appreciate all your support, and make sure you come back to the channel tomorrow night. Cheers.